What are you making of what's happening here as well?
Look, I think this, the 2 decades of freewheeling expansion are over. I think now that the cost of living and the impact that and the potential threat that poses to the authorities' grip on the economy is such now that changes and a response are required. So basically, if it is in the interests, or if it's in the national interest, if it is for common prosperity, then for investors, I'm pretty positive. If it's not, then action will be taken, and those are the sectors to avoid. So it's a pretty stark, somewhat binary outcome right now, particularly if you look at the performance of sectors in favour and sectors out of favour over the last 6 months.
Is it, well, I guess the question is being able to figure out which is which, and who would have known just 2 weeks ago that we talked about milk, for example, and dairy producers, and they're now coming under a little bit of heat this morning. Spilled milk is what we're calling it. What's the natural equity hedge in terms of sectors there? What would be, in your view, the safest place in the equity market to be?
Well, look, I think one of the standout themes and trends in China right now is the commitment made by President Xi last year to carbon neutrality. Remember, he committed China to carbon neutrality by 2060. So for us, this ESG carbon transition is by far the most important sector to be invested in. And just to give you some context, over the last 6 months, ESG-related theme is up some 25%. Just in the last 6 months. And if you compare that with education, with online gaming, with tech more broadly, and fintechs, of course, the difference is night and day. So these are the areas that we are encouraging investors to embrace. And clearly, at the same time, there are those that we need to avoid.
Well, he didn't plug his fund, which has done very well, which is a blessing, I suppose, but which is it an ESG fund? But I want to just get to, whether this is an ideological shift as well, in the sense that we've got the education stocks, of course, being hit, delivery people because they may be exploiting some of their drivers or whatever along those lines. And that language used, which was retracted about spiritual opium, does this reflect a more return to a socialist-based economy in a way, and a more planned economy even?
I think it does, Rish. On balance, I think it does. I think it represents a pretty profound psychological and philosophical shift in the approach to so-called business as usual, as I mentioned, in the last 20 years and going forward. So I think right now the national interest and common prosperity are the 2 driving themes in investors' minds. And if they can navigate what that means, I think China still remains a highly attractive and profitable place to be invested. But if you don't know what that means, and if there is some confusion, then I think there are pitfalls and landmines everywhere.
The equity story has really been US, Europe one side, Asia-Pacific, EM the other. That divergence has really been quite stark. When does that change? Do you expect it to change anytime soon?
Not anytime soon, no. I mean, let's remind ourselves, Asia has been underperforming developed markets since 2011. So continued underperformance is not such a huge shock. I think there are pockets of opportunity, pockets of value, and we've discussed a little bit about the ESG theme in China. But the reality is clients here are mobile. Clients here are willing to invest outside the region. They're not necessarily constrained by investing in Asia, and a lot of our clients, for example, explore frequently opportunities in the US markets. There's a home bias, of course. I appreciate that, and certainly there have been opportunities in Taiwan and Korea. Focusing very much on the semiconductor industry. That has been a standout performer in the first 6 months of the year. But overall, we look at the earnings picture in the United States, increasingly in Europe, and we continue to see relative value and relative outperformance in those markets.
Does the jobs number, what sort of number would move the dial for you here? And do you think the Fed's looking more at the employment number right now rather than inflation in the pipeline, perhaps, because they're kind of discarding that and putting that in the dustbin, saying, hey, it's going to be temporary?
Well, Credit Suisse is right to the top of the upper forecast. We're at 1.1 million for jobs. And this is largely driven by services. It's largely driven by a return to consumption and services-driven consumption, which we think will positively impact jobs. I think the sort of the goods-driven consumption is probably peaked and ticking lower, and that's possibly a little negative for the trade balances of Asian economies. But for us now, we're seeing actually a peak in goods-driven inflation, and I think subsequently a focus more on services-driven inflation, and that for us will be reflected and captured, I think, by these job numbers tonight.
Yeah, to your point, the Bank of England out yesterday, they're worried about inflation. You look at the Fed, they're not worried about inflation. And, you know, that's a story that's fairly consistent, really pretty much down the line. It's the same type of inflation, though. Like, you got to wonder why one set they're worried, one set they're not worried. As a CIO, what do you do with that information?
Well, firstly, I think that the goods-driven inflation risk will diminish. I mean, I think supply imbalances, I think some of the supply chain disruptions will repair reasonably quickly, and the impulse from that inflation will moderate. Wages and services-driven inflation, possibly a different story. I think we've probably going to see another leg higher in that metric in the coming sort of 6 months or so, but for broad measure, 4% inflation in the United States this year, 3% next year, and probably closer to 2% the following.